Our next guest has an S&P year-end target of 5175. It's about 10% above where things currently sit. Joining us now for a closer look at what he's seeing in the charts, Mark Newton, head of technical research at Fundstrat. Mark, good morning.
Thank you, Mike. Good morning to you.
So we have what seems like perhaps overdue and somewhat controlled pullback, I guess, going on in the indexes. The S&P off 2+% from its recent high, had 9 straight up weeks. Everyone said market was overbought, overheated, got to cool off. Is that what's going on? Do you expect it to continue to be routine?
Yeah, I think the narrative had probably gotten a little too complacent heading into year end. That's normally the case, seasonally speaking, but people were a bit over their skis in terms of the thinking of disinflation and the labor market easing. The bottom line is that the data has been inconsistent with that view. It's been quite resilient and strong. The pullback that we've seen hasn't been all that technically damaging to the market. We've seen a necessary mean reversion in some of the former leaders like technology. But meanwhile, we've seen other groups like healthcare, which have recently started to outperform. So I see this completely as being very healthy. And if anything, it's going to be a chance to buy for investors in the days ahead and potentially as early as today after the jobs report. Yeah,
there is certainly a lot of rotation within this index retreat going on. A lot of excitement, I guess, about the slight catch-up move in small caps and the broader list of stocks against the very largest ones. Do you expect that to continue? Or, we have something like Apple down 8% off its high. It's down a lot more than the market is right now.
I do like small caps for 2024, Mike. I think a lot of these groups which have been out of favor are slowly but surely starting to show evidence of coming back. And small cap certainly is a group that should do very well as rates start to pull back. And my own thinking is that the 10-year likely gets down to 3.25 this year, potentially as low as 275. So that certainly would be a good thing for the small cap arena at a time when they have really underperformed pretty dramatically for years and years. And so this will be a necessary period of catch up, which happens this year.
I mean, that would suggest that you think treasuries are a pretty strong buy right here, right, with the 10-year at 4. Is that just based on the patterns that you're witnessing, or does that embed some, rate cut assumptions or what inflation's going to do?
I don't think it's going to be a straight line. We've already seen, over 100 basis points or so of pullback in the 10-year of late. And so it's not going to, I think in general, in the first quarter, we probably will see a little bit of a bounce in treasury yields. But my own thinking is that is going to happen between likely the spring of this year, probably into the late summer. And a lot of that is predicated on cycles that I look at with 10-year yields starting to pull back pretty aggressively. So, I mean, the good news is, look, the U.S. is in much better shape than most of the world. And so that's obviously a very good thing. But my thinking is we are going to see a continued retreat in yields.
You've mentioned that the S&P might actually sort of run its course in terms of this pullback, even as soon as today after the jobs report. At what level would you suggest that this is showing itself to be more than just an orderly little pullback that you'd want to buy?
Yeah, that's a good question. Look, I think anything under 4,600 would be certainly a concern for short-term bulls. But, the bottom line is that we've seen such a huge period of catch-up in broad-based participation in many of the sectors which had lagged so substantially. And so it's really right to concentrate on the degree of which all these other sectors are beginning to join the rally and buoy the market at a time when technology has started to pull back. So if anything, it's a very healthy rotation. Look, we have, close to 80% of all stocks above their 50-day and 200-day moving averages. Things have gotten pretty overdone with regards to breadth. Momentum, though, arguably is really not that overbought, and that's the key.